Hi everyone, welcome to today's video. So on today's video, I'm going to talk about a small cap stock which I have started to buy on dips and I'm aggregating it. I have already done the first big purchase on this stock and I'm going to continue to make this investment. So which stock am I talking about? Please watch the video till the very end. You will get the answer. You will understand the entire arguments why I am buying this stock. Very important disclaimer, this is not a buying recommendation. Please do your due diligence and only then enter the trade. In the interest of full transparency, I disclose the investments that I am making. You can understand the rationales, logics and then take a trade. You can take a trade, avoid it, but do it at your own free will. The important lesson that I would want you to take away from this discussion is around the concept of risk. This is a very important point because I keep taking a lot of heat from people that, hey Akshat, why did you invest in JP Power? By the way, that stock is up by 28-29% already. Why are you propagating investing on such risky stocks, this, that? So I feel that people have a very bad understanding of risk. And let me demonstrate by giving you an example here. So if I ask you that do you believe in the concept of higher risk, higher rewards, that this is an American concept that the higher risk you take, the higher your rewards will be. For example, when you go and invest in small caps, therefore your risk is higher, therefore the rewards are higher. Do you believe in that narrative? If the answer is yes, then you have misunderstood the entire concept of risk. Let me prove that point by giving you a couple of examples also. But the first golden rule of risk is that please don't take risk with things that you can't afford to lose. I'll repeat that again. That please don't take risk on things that you can't afford to lose. There is no such thing as 100% guaranteed returns in anything. So please be smart and logical around this concept. So this brings us to the sponsors of the video, which is Ditto Insurance. I love their insurance product. I myself and many of my family members have purchased insurance from them directly. And insurance is something that all of us should have. Now, why do I advocate the firm? Very simple. That you can use the link in the description box, schedule a free call with them. You don't need to pay anything. Speak with an insurance expert, get an understanding of how much insurance you need to take, what type of insurance. There are so many complexities that they can help you demystify without charging you a penny. It is a great product, therefore I am advertising it. Check the link in the description box. Now coming to the second golden rule of risk, which is the higher the risk, the higher the reward. No, this is a flawed concept. It doesn't work that way. Let me demonstrate that by giving you a couple of examples and then I will disclose the name of the stock that I am purchasing. Now let me give you the example of L&T. Now many of you would think that hey, L&T is a large cap stock. It is a very big company. I've heard of it. Larsen & Toubro, such a big company. So let's take a look at the 5-year returns of L&T. Right? So here are the 5-year returns for L&T. And it has given approximately 75% return in 5 years. Now you'll say, Akshat, what is bad with it? 74-75% return. Very good. Okay. Now compare this to Nifty 50 returns. Now this is the return that you have received in the last 5 years from Nifty 50, 109 or 110%. Now good 35% difference between the returns of Nifty 50 versus L&T, right? Now you might say, Akshat, you know what, you are wrong here because L&T is a risk-free stock, right? Risk-free stock. It does not have a lot of risk. So how do you and I decide what is risky versus not? For this, we need to take a look at long-term beta of the stock. I'll explain that subsequently on the video what beta means. But beta is essentially a measure of volatility. Okay, volatility, right? So this is a measure of volatility, and if the stock has a beta of 1.39%, 1.39, it means that the stock is 39% more volatile compared to Nifty. For example, if Nifty moves by 100 points upwards, then the stock should have given you 39% more returns. 39% more returns in an upward market. But what did you see? That the Nifty went up by 100 points and despite having higher risk with L&T, it fell down. Despite it being a large cap stock. So what am I essentially saying about L&T? That L&T is a high risk stock that is giving you low returns. This is the worst possible combination that you can have. Now the opposite is also true. Sometimes you might say that, hey Akshat, you know what? If we take a look at any small cap, it will have more volatility and therefore it will have higher returns. Not true. And I will show you one stock today that has low volatility but high returns. High returns, right? And in fact, it has high potential returns also. So which stock am I talking about? So I'm talking about Amritanjan Healthcare Limited. This is a yellow balm that you would have heard of or our parents or grandparents would have heard of because this is a very old company. They used to make Amritanjan balm, then they got engrossed in a bunch of other different type of businesses which did not work out. Now subsequently, post 2002-2003, The third generation of this business has started taking care of this business and they are turning things around. So I'm going to talk about Amritanjan Healthcare and I'm going to dissect this stock. But very quickly, let me further build upon the theoretical part of risk. I'll keep it very brief and to the point, and you will enjoy this discussion, because if you hear about this concept in an MBA classroom, the teacher usually takes approximately an hour explaining it. I'll explain it to you in a very practical, no-nonsense way. Okay. Now here is a concept that you must know, and it is called as capital asset pricing model, right? So this is the first key concept that you must know. And before this, you must understand a concept called as efficient market hypothesis. Now, efficient market hypothesis simply means that, hey, if you take a look at any efficient market, for example, US, Europe are efficient markets. Why? Because there is very few insider trading, the data availability is really nice, everything can be scrutinized very well, the regulators are there, they keep a heavy-handedness on people who are selling and buying stocks. So these are efficient market hypothesis, and it typically says, right, from an example, that even big investors do not have any systematic advantage over small investors. Okay, so what does this mean? It simply means that, for example, if certain news comes, right, then there is no insider trading that is happening in the US. Everyone has same access to data and information. Of course, someone is more skilled, they will make more money. But there is no systematic manipulation of information, or there is like efficient flow of information that people are getting information in a timely manner. No bad things are happening, and everyone gets a fair play to make money in the stock market. That is what efficient market hypothesis simply says. Now this leads to this particular concept around capital asset pricing model, and please understand these technical things. This can help you impress people and impress interviewers and impress your dates and whatnot. So listen to this very carefully. Okay, so essentially this is how you measure risk, right? The entire argument about L&T that I was making, it was based on this formula. So what it simply says is that in an efficient market, right? So if you assume that the markets are efficient, that is what is believed the market should be, then every stock's risk can be categorized according to this. ER means expected return. For example, when I'm investing my money in L&T, what should be my expected return? Should I expect like 15% from it? Should I expect like 25% from it? What should be my expectation? Okay, so very easy for you to judge. That what you do is that you take the risk-free rate, which is usually the FD rate, 7%, right? And add a beta to it. Beta is the volatility, right? I explained the concept of volatility just a few minutes back. So please rewind it, watch it, right? So that's the beta premium. And this is the market risk premium that you're assigning, right? So beta times the market risk premium. This is a formula that should tell you that how much return should you be expecting. Now let's not get into the math of it, but let's just try to commonsensically understand the point that this formula simply says there is a direct relationship between the expected returns and the risk that you take, right? But this formula is based on what? This formula is based on efficient market hypothesis being right in the first place. Now, India is a place where the efficient market hypothesis is not right? India is not a market where efficient market hypothesis holds true. Why is that? Because in India, the cost of capital is very high. In India, the flow of information is rigged. These are all my personal opinions, so Sevi, please don't sue me. This is my personal opinion that the markets in India are inefficient. There is insider trading. There is a bunch of different things that are thrown in, which rigs the system. Therefore, the market is not efficient, and therefore this formula does not hold true, and therefore we have companies like L&T, which do not give you proportionate returns in accordance with the risk. So this is the theory part of it. Now let me show you how you can make money by using this principle. Super simple, right? Now let us identify a stock where the risk is lower. So I have told you the name of the stock already. It's Amritanjan. According to me, it has lower risk, and I'll explain it to you point by point why I feel that the risk in this business is low. Okay, so here is the beta for Amritanjan. Long-term beta, it's 1.21%. It's lower than L&T. Okay, let's take a look at 5-year return. Same matrix that we use for L&T. The returns are 225%. Higher than Nifty, much higher than L&T. So if you were to put your 100 rupees in L&T versus Amritanjan, where should you pick? Just in terms of risk-reward equation, 100% you must invest in Amritanjan. But let me explain it to you why the risk-reward equation is so fascinating for a company like Amritanjan, and it should continue to be the same. Or rather, in fact, the risk-reward equation should further improve. Now, why am I saying this? So primarily, there are 3 specific reasons why am I saying it. So the first key reason is regarding the core business of Amritanjan, and you can check that in the head balm space, it has 43% market share. It's almost a monopoly from that perspective. It's a major player. So it has a very stable core business. That's point 1. Second, in the new businesses in which it is entering, and I'll talk about this subsequently, it has started to gain market share. So it has a stable business and it has a growth business. Combination of both reduces the risk. It's not as if that it is like Reliance, which is now experimenting with a bunch of different businesses. It is not like Facebook, which is experimenting with a new business line. So essentially, Amritanjan is a business which has a core stable business and a new growth business. Now, a related point here is that the nature of the market is very stable. It's not as if that the customers will go away or there will be like some kind of a trend change that is happening here, that people will stop availing relief medicines. There are more and more people who have like pain related ailments and issues, and they will continue to avail these type of services. Now, you might make an argument that, okay, Akshat, you know what, people might not put balm. I'm like a Gen Z and I don't use balms. I use like relay spray and bunch of different things. So that product nature might change. Good question. So essentially, if you take a look at their product portfolio, you will find out that they are experimenting with a range of products. For example, this is the annual report and they are experimenting with like sprays. They are experimenting with relief patch. This is an innovative product that they have launched. They have launched a bunch of different products in the pain relief space. So overall, they have already built a bouquet of pain relief platforms and they understand the space really well. Now, another related point here is that they have their distribution sorted out. This is a very widely dominated player in South India. It is based out of Chennai. It has wide distribution network. Now, to add on to more SKUs, which is like more products in the range that they are asking more distributors to sell their products, they don't have to go and find new distributors and retailers to do it. They are the same distributors. They just have to push out more portfolio of products. The nature of product is such that, they will not expire so easily, right? It's not like a perishable product. So the supply chain is also very stable. So from a broad angle, Amritanjan operates in a space where it has a stable brand. It has stable distributors. It has a range of products which are diversified, which are alignment with their trend. They have a growth product in play, which I'll talk about in a minute. That is also there. Plus, regulatory changes are not going to impact this. It's not as if that Amritanjan has to do a bunch of R&D and take like a bunch of approvals. They are selling mostly over-the-counter medication, so the regulatory hurdles are also less and even R&D spent is also very less. Now, this gets reflected in their financials. For example, if you take a look at their financials, you will see something really amazing. For example, in 23, the sales were 135 crores. Now it stands at 364, right? Within a matter of 8-9 years, the sales have 3x'd. Big achievement. Now, because it is a family-owned business, they are developing organically. It's not like as if that just to show some sales number, they are not going profitably, nothing like that, right? If you take a look at profits, that the sales have tripled, but the profits have become 5 times. This is called as profitable growth. It shows that the company is truly bothered about the profit margins. They are not running a business just for the heck of growing sales. That's one part of it. That, start selling like waffles at 10 rupees and start sending it to people's house just to increase the sales number. A lot of food tech companies have done that. That is madness. This is solid sales model that every time you sell a unit, you are making money of it. This gets reflected in the cash flow. So let's take a look at cash flow. Cash flows should be positive. Okay. So if you take a look at free cash flows, here are the numbers. Free cash flow. It means that the company is growing the equity value. Because the company has free cash flow, it can reinvest that money to build more factories. Bunch of different things. They have money in hand. So net profits are also there. The operating margins are also improving. Free cash flow is also there. It's such a stable growth company, and then people say that it's a small cap stock, therefore it is super risky. No, it has lower beta than L&T. It has no financing cost issue. It is operating in a stable market. So bunch of different good things happening for this company. Now comes the third and final point that, hey, what is the growth potential of this? So I would feel that the growth potential is massive because the stock is still trading at 36 PE, which is not very high. There can be PE expansion. For example, if this PE becomes 72, guess what? Your stock price will at least go 2.5-3 times X, because that is when investors start noticing these type of companies. So great company from that perspective, and it is reflected in terms of how they are managing their business. For example, they could have taken like big contracts earlier on when they started revamping their Amritanjan brand. But they signed an IPL contract very recently, right? They started sponsoring Chennai Super Kings. I'll put a picture somewhere here. That's a good marketing strategy for them. But it's not like VC-backed marketing, right? This is the money that the company is earning and then spending on marketing. Sensible, responsible marketing. Why am I saying it? So here is a chart for you. So take a look at channel performance, and their over-the-counter business has grown by 30% in the last 1 year. Again, whatever money and profits they are making, they are plowing it back depending on their weak areas. That's 2. Now, what are the growth products that I'm speaking about? So there are specifically 2 growth products that I'm speaking about. So one is sanitary pad, and if you do a little bit of research about this, so one is that females in India, only 1 out of 3 females in India use sanitary napkins. and the major barrier for that is the cost constraint. So of course you have like these high brands which are catering to urban women, etc. But Amritanjan sanitary pad is going to cater towards low income people. So it can be a major growth channel for a company like Amritanjan. So this is one value driver because Amritanjan right now has a very small market share. They have started onboarding celebrities, have a distribution figured out. So this is only a matter of time that this particular business stream for Amritanjan will start gaining prominence. The second key thing is their proprietary product. So they have already been active in the pain management space. Now they have launched something called as Advanced Pain Relief Patch. Now I have personally not used it, but the feedback that I'm getting after reading a lot of articles on this is that this product is very effective and will be widely used. Why? Because it gives you very focused relief. With this type of product, they can further improve their ROCE because they can sell this type of product at a high margin. The sanitary pad business might become a volume game for them. This pain relief business will become a high margin business for them. So no matter what we look at, whether the industry is stable, yes. Whether the company is stable, yes. Are they undertaking brand expansion? Yes. Are they launching the right type of products? Yes. Is the management good? Yes. Are the financials clean? Yes. So no matter how you take a look at this firm, it comes across as a very clean firm. That is my understanding, and therefore I am an investor in this firm. I had already invested in this firm and I would continue to buy this firm whenever the opportunity presents itself. So I hope you enjoyed the video. Please give it a thumbs up and I'll see you the next time.